All right, so here we are, right? The chapter 9 and 10 petty cash, bad debt, interest, and bank reconciliation. So, this is the whole entire thing, okay? So, let's go ahead and break it down, starting with question number 1, right? Okay. So, question number 1 says that on January 1st, you opened up your store and needed a petty cash fund for emergency expenses. Of course, you established that $500 should be enough for the first month of operations. Okay, so go ahead and journalize this transaction. How would I journalize that I'm establishing a petty cash?
You debit petty cash 500, credit checking 500, and put in your notes that you're establishing a petty cash for 500.
Good, right? Because we're creating a petty cash fund. Where's the money going to come from? It's going to come from your checking account. Right? To establish petty cash fund, right? For the amount of $500. Okay? Good. Number 2, okay? That at the end of the month, you counted all of the receipts in the petty cash drawer, okay? And of course, you had a total cash worth of $40.03 in cash remaining in the box. Replenish the petty cash drawer. So in this case, here is the petty cash drawer ledger from the manager, okay? This is what they recorded, that these individuals took out all of these monies for these expenses, and this is what they took out, and this is what they brought back the receipt for. This is the amount of change, and this is what the amount is remaining in the petty cash drawer. So as remember, right? So in this case, if we establish our petty cash drawer at $500, right? That's what we started out with, and then slowly we had some people just go ahead and go through the petty cash drawer, and at the end of the month, here is your ending balance. You have $40.03. So how do I take this information and how do I replenish my petty cash drawer?
You debit the expenses that are there.
Okay.
So you group each expenses together and total them,
Okay.
and enter each of them as each expense, and then you total them, and then, well, we already know, but we need to make sure the total is equal to the total amount of the spend, and then we subtract that amount from the checking account as a credit.
Okay, so go ahead. Tell me every single account that I'm going to put in here and what the amounts are.
So I have office supply expense.
Hold on. So you have an office supplies expense.
Yes. I just took it the way we showed up. Like a movie.
Okay. I'm just gonna go ahead and shorten it up. Okay, office supplies expense.
It's $26.80.
All right. So in this case, right, we need to figure out how did you get $26.80. Well, let's take a look. Well, we got one for $19.85. Right. You used the receipts, right, not the money that you took out, right?
Yeah. Yes, I took the receipt amount.
Okay, so you got $19.85 here. And let's see, you have another office supplies expense right here for $6.95. And that is it for $26.80.
Yes.
Good. What's the next account?
The business expense. And I have $107.28.
Okay, so let's go ahead and take a look here. Who took out the first business expense? Susan did for $54.17.
Yes.
Okay. Then the next business expense was by Harry, okay, for $22.78. Okay.
Yes.
Next one is Miss Susan again for $30.33, which got you the $107.28.
Yes.
Okay. What's
And
next?
is meals expense.
So let's see. Our first meal was taken by Mary. Okay. Mary for $35.22. Then we got another one by Susan for $15.67. Then we got one. That's it, right?
Yeah, so I have $50.89.
No, $50. Okay, good. What's next?
Delivery expense. It's $175.
$175. So let's go ahead and take a look. Our first delivery was done by Harry again for $50. Then we got another delivery by Mary for delivery. Oh, sorry, yeah, delivery by Mary for 100. And then we got another delivery by Harry for 25. Okay, giving you a grand total of 175. Okay, what's next?
Advertising is $50.
Let's see who did the advertising expense. Miss Susan for $50. Okay, and what else? Anything else?
Yeah,
I
and also
know.
Owner's withdrawal, right? For how much?
$50.
Yep, the owner took $50 from the petty cash drawer. So in grand total, and you said what's last count?
Mine totaled up to $459.97, with that $40.03 left in the petty jar. It's $500, so my total was balanced out.
Okay, so what account is this $459.97?
We are taking the checking.
Yes, we're gonna take all of these expenses and all these receipts, and we're gonna replace them with some cash by taking it out from the bank. There you go.
Yes.
All right, and your note here is to
The punish, no, what's the word?
replenish.
Replenish, yes.
For all of these expenses that are here, if you want to put the date on them, usually you could do that by marking on their ledger. I'll show you what that is when we dive into the fictitious business, but you don't need to put it in the journal. You will have a space to put all the notes and all the things that you need to put in there in regards to that transaction in your general ledger. Okay. All right. So there you go. You got office supplies. You got office supplies expense. You got some business supplies. You got some meals expense, delivery expense, advertising expense, and of course, an owner's withdrawal. So this is basically all the expenses you're recognizing for the month of January. Okay. Number 3, on June 1st, okay, your business began to pick up, and the last few months you were running low in the petty cash. So in your petty cash drawer. So of course you decided to increase the amount to by $300. Okay, so how do I record this transaction? I need to increase my petty cash drawer. So how do I do that?
We need the P.
Debit petty cash 300. Credit checking 300. And make a note that you've increased the petty cash fund to 800 or whatever.
Okay. Good, right? To increase, you just basically put the money amount into the petty cash drawer, and you're going to write a check to go get it cashed out. Okay, so let's see what's next. Number 4. Excuse me. At the end of the year, you decided to get rid of the petty cash drawer and use a business credit card for all of the expenses. So record the closing of the petty cash drawer. How do I record the closing of the petty cash drawer?
You debit checking for the 800. You credit petty cash for the 800. And in your notes, you say that you're closing the petty cash.
All right, good. To close out petty cash. Good, right? What are you going to do with the money in the petty cash drawer? You never pocket it, okay? What you're going to do is you're going to throw it into your checking account, right? Because that's where the money began. So you're going to put that back in there so you can continue operating the rest of your business by not having $800 laying around on the table. Okay? Good. All right, so that's questions 1 through 4. So let's go ahead and dive into questions 5 through 10. Okay? All right, so let's go ahead and take a look here. Okay? All right, so here, of course, you're going to assume these questions are different. Okay? So in this case, we're going to be moving on to another concept here where on June 15, customer A purchased a total of 100 toys for $5 each on an account. Okay, sales tax is 8.25%. Record this transaction. So, right, that's the first thing I got to do is question number 5. I got to record this transaction on June 15 that customer A purchased a total of 100 toys for $5 each with sales tax of 8.25%. So how do I record this?
So sales is 500.
Okay, so we got sales. Okay, so that's definitely what we got to recognize. And
you use toys is where it comes from. No, you get cash or account receivable.
Good.
And and you got sales tax. And I'm trying to figure out what that is.
Accounts receivable.
Sales
And
tax payable. Your sales tax is 41.15. Sales is 500, and accounts receivable is 541.15.
uh
Did you get a different number? I'm trying to punch it onto a little calculator.
okay, because yes, I believe this number is different.
Yeah, 500 times. Whoops.
8
I'm getting numbers wrong. Sorry.
it's 8.25% sales tax.
Right.
It's quarter.
Yeah, $41.25. So therefore, your grand total, I'm in the wrong cell. Your grand total should be $541.25. And I'm going to make a note here that what? We sold 100 toys to customer A. Now, in this case, let's assume this isn't an inventory question. So in this case, we're just going to journalize what the transaction is happening because this is the receivables part, right? We're focusing on what happens to this receivable. Okay, so no need for the toys and cost of goods sold. Okay, all right. So that's just question number one. That's the first question number 5. Okay. So then question number 6 on July 15. Okay, we received a payment check for $50 from customer A. Record this transaction. So we received $50 on July 5th from customer A. I think it was July 15, right? Yeah, July 15, we received a $50 check from
Going to your debit checking 50.
Good, right? Because in this case, what do you do with the check? It's going to go straight to your bank. So in this case,
And then you credit accounts receivable 50 and make a note who it was from.
okay? And we're going to make sure we indicate received payment from customer A. Okay? Question number 7 says, then on August 15, customer A refuses to pay for the remaining amount that she owes. Record this transaction. Okay. So by August 15, customer A missed their payment, and now she refuses to pay the remaining amount. So what do you do with this here?
We transfer to allowance for doubtful account.
Correct, right? But in this case, because now this account is at risk for potential bad debt, right? And we call that by using the allowance for doubtful accounts. So I'm going to do allow for doubtful accounts.
And her balance is $491.25.
Okay, so how did you figure that number out?
She already paid the $50, so I just deducted the $50 from her original balance.
Okay. So $491.25. And what's my credit going to be?
The account receivable.
Good. Why we need to remove her account, that balance that she owes me, because this entire amount is subjected to not be, payable, right? she's refusing to pay for this amount. So let's see what happened next. Okay. Of course, right? We contacted customer A to retrieve the debt that she owes. Okay, on October 20th, we finally received a payment of $15 from customer A. Record this transaction. Right. So we spent a couple months here. So it was August, right? We spent September and we finally spent October, and she finally gave us $15. So what do we do with this payment?
So
You debit accounts receivable for the $491.25.
Okay.
Credit allowance for doubtful accounts
Okay.
for the same amount. Make a note that you are reinstating her account.
Good. Good. That's exactly what we're doing, right? We need to reverse it because in this case, we have hope that she's going to continue paying for what she owes, right?
Right. And then the next entry is checking is debited for the $15 and accounts receivable is credited for it. And you make a note of her payment.
Okay, so in this case, let me go ahead and, oh, I forgot to make a note here. Let me add a note here real quick for this one. Okay, I'm going to make sure I say that to remove customer A's account receivable balance. Okay, and then I'll just use your words, right, to reinstate customer A's accounts receivable balance. And then you're going to record the payment that you received. So we're going to be receiving money, and it's going to reduce the accounts receivable, okay, by $15. Okay, and I'm going to make a note here that we received a payment from customer A. Received payment from customer A. Good. Okay. So let's see what happened next. Then, November 28th, a debt collector informs that customer A has filed for bankruptcy and can no longer pay. So, how do we record this transaction?
so we're gonna transfer again from account receivable to allowance for doubtful account.
Good. Excuse me. On November 28th. Okay? So, again, because now this potential debt has been confirmed, right? But we haven't reached the end of the accounting period yet. So in this case, we need to at least remove it from the accounts receivable because now we for surely know that this account is inactive. Okay? For how much?
So now her balance is $476.25.
Okay? All right. And then this is going to be to remove customer A's accounts receivable balance. Okay. And then last but not least, on December 31st, okay, our company has estimated that $2,556 out of our 200,000 accounts receivable is to be uncollectible, and there's currently a debit balance for $476.25 in the allowance for doubtful accounts. Go ahead and record this adjustment. Wait, did we get the number already? Yeah, 476.25. Okay, so now there you go. How did we get the debit balance? Well, there you go. This is exactly how we got it, right? There currently is a debit balance of $476.25. So what do we do with this?
So, we're gonna add the debit balance to the estimated balance,
Okay.
and that would be the total of the bad debt expense for
Oh.
the debit.
Okay, good. So bad debt expense.
Yes. And then we credit the same amount from allowance for doubtful accounts.
So it's December 31st, right? We need to do a bad debt expense. Okay. You said we're gonna take the $476.25 plus the $2,556.
Yes.
Okay, so you should get $3,032.25.
Yeah.
Okay, and you're gonna credit the allowance for doubtful accounts.
Yes.
Okay. And if you want to put in here, you could say to write off uncollectible debt for the year. Okay. And of course, you could say which includes customer A's balance on there. It doesn't matter what you want to do. It's your journal. So if you want to be as descriptive and more accurate as possible, you may do so. Okay. But again, you have room to put all of those notes later on, and I'll show you how to do that when you dive into the fictitious business. Okay? Good. So, this is an example where you have a customer, they charge their money on account, and then eventually at one given point in time, they stopped paying, they refuse to pay, they don't want to pay. For whatever reasons that does happen, you have to flag them down immediately because that is exactly when you know who, and you know exactly how much they owe you. Okay? So hence that key word, right? Why we use the allowance for doubtful accounts, because it is currently during the year. Okay? During the year, this is what happens when you have someone who fails to make a payment for what they owe. You have to flag them as potential debt. That's what the allowance for doubtful accounts is. It's potential bad debt, right? It's not confirmed yet, but in this case, it's potential. So that means you have a slight possibility of getting that money back somehow. Okay, whether you know where you keep bothering them, and to the point where they just say, okay, here, right, you're right, I owe you money, right? Second thing is that, so once you have inactivated your account, you can't just take it off of the allowance for doubtful accounts, right? Because that is your placeholder that you're temporarily putting their account information in, because it's currently inactivated, because it's potential bad debt. You don't know whether or not someone's going to make a payment or not. So in this case, when that person does make a payment, you have to reverse that transaction, because then you have a possibility that that person's going to continue making payments. So in this case, you need to reactivate their account, which is by undoing the allowance for doubtful accounts and putting it back into the accounts receivable, right? You receive a payment, right? You receive a payment until it comes to a point where once you acknowledge that this person is confirmed that they can no longer make a payment, you must inactivate them, right? You got to move their accounts into the allowance for doubtful accounts, because at the end of the year, what happens is you're going to write it off as confirmed bad debt. That's the process, and that's why there is some kind of account balance, right? There could be a debit balance, a credit balance, because of this idea right here, right? Now that I have a credit balance of $3,032, what happens if next year I get another account balance where it decreased it, because every time you debit the allowance for doubtful accounts, what happens? It's going to bring it less to the credit side, and that's why you still have the amount to be on the credit side because of that very reason. So in this case, that's exactly where those numbers come from. So this is why I'm showing you how to do it like this, because this is the proper way of doing it correctly through, and this is one is widely accepted through GAAP for accountants, right? You are not the tax accountant. You cannot directly write it off directly out from the accounts receivable. Okay? You need to do these procedures and these steps to slowly transfer the money from one account to another account to another account. Okay? And that's why you ended right here where you're completely confirmed that you're going to be ending up writing off that bad debt and taking that loss. You need to transfer it out from the allowance for doubtful accounts. Right? All right, so that was that one. Okay, so let's go ahead and move on to questions 11 through 14 here. Okay, so here is some mix and match examples of bad debt that I want you to practice. Okay, so for question 11, on December 31st, your company has estimated that $2,430 of a $500,000 total credit sales is to be uncollectible. Okay, and there's currently a debit balance of $1,500 in the allowance for doubtful accounts. Record this adjustment entry, or in this case, the adjustment entry should be right. So in this case, what should I do? Which method am I using to?
You're using the income statement method
You're using the income statement method?
because it says total credit sales. So you use bad debt expense for 2430
Okay.
and you debit that, and you credit the allowance for doubtful accounts for the same 2430.
Okay.
Because you don't figure in the balance on that, because that's a business or a balance sheet expense.
Good. Excellent. Right? That's completely correct, right? Because we're looking, oh wait, you said the income statement method. So in this case, good. That's correct, right? Because on the income statement method, what are we looking at? We're looking at total credit sales. Nowhere on the income statement will you ever see accounts receivable or allowance for doubtful accounts. So in this case, you choose to ignore that piece of information that follows after that sentence. So therefore, we are only focused on just the estimated number. So in this case, that is correct. I'm gonna go ahead and we're gonna do bad debt expense, and we're gonna have the allowance for doubtful accounts, and it's going to be for $2,430, right? Because that's what the estimated number is, okay? And that's what our journal or entry should look like. Okay? Question 12. If on December 31st, your company estimates that 2,430 of a 500,000 accounts receivable is to be uncollectible, And there's currently a debit balance of $1,500 in the allowance for doubtful accounts. So the adjustment entry is
Balance sheet method.
balance sheet method. So in this case, do we care about what the balance in the allowance for doubtful accounts is?
Yes.
Yes, we do. And how does it affect it?
You add it to because it's a debit balance.
Good. So in this case, we're going to be adding 1,500 to the 2,430.
So it's 39.30.
Good.
And you do bad debt expense as the debit, and you credit the allowance for doubtful accounts.
Good, right? In this case, doesn't matter what method that you use, right? The journal will be the same. However, you can only choose one or the other methods, okay? You can't double write off your bad debt, okay? You can only choose one either method. Now, whichever one makes sense to you, use, right? What about question number 13? Where on December 31st, okay, your company estimates that $2,430 out of 500,000 accounts receivables to be uncollectible. There is a current credits balance of $1,500 in the allowance or doubtful accounts. The adjustment entry is
It's the same as that, the bad debt and the allowance, but you're subtracting the 1,500, so your totals would be 930 because you're still using the balance sheet account method.
good. So in this case, we're going to take the 2,430, and because there's a credit balance of 1,500, you are already on the right side. The main goal is the estimated amount is what you're trying to get your ending balance to be. So in this case, right, if I'm already on the right side, how many more do I need to get to that exact number 2,430? You're going to subtract the two numbers, okay? And that's going to give you 930. Okay. Last question 14. If December 31st, your company estimates that $2,430 of a 500,000 total credit sales is to be uncollectible. And there's currently a credit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry will be or should be
Debit bad expense for 2430 and credit allowance for doubtful accounts for 2430 because you don't consider the asset account.
good, right? Excellent, right? We are using the income statement, which once again, you only see total credit sales. You don't see anything about an accounts receivable or the allowance or doubtful accounts. So in this case, you will choose to ignore the account balance. So all you're looking for is just the estimated amount, which is the $2,430. Good. All right. Okay. All right. Question 15. All right. Go ahead and practice this right here. Question 15. You have a simple interest here. Okay. So in this case, question 15, right? I gave you a principal, rate, and time, and you need to figure out what the interest and what the future value is. So in this case, if I have a principal of $28,000 at a rate of 4.35% with a time frame of 150 days, what is going to be my interest here? What's my total interest collected at the end of 150 days?
I have $507.50 because I considered 150 day as a 5 months.
Okay. So 150 days is 5 months, right? Because if we know
Yes.
that 30 days is equivalent
To a
to
month.
1 month, right? So 150 days is going to be 5 months, okay?
Yes. So the interest was is $507.50. Because it's principal times late plus times time.
Now, time, did you just put 5 or what did you do?
I did a 5/12.
5 over 12, good, right? Because this is 5 months out of the year, right? The goal is, because the rate is in annual percentage, right? You need to convert time into an annual time rate as well. So in this case, 5 over 12 will give you $507.50. So what is my total future value going to be?
So you add the interest to the principal, and then we get $28,507.50.
Okay. Good. So what about the second one? If I have a principal of $5,147.50 at an interest rate of 6% with a 10 years time frame.
So for that one, we don't have to do any conversion of the time because it's already in years. And so I have $3,088.50.
Okay, so this one, no need a conversion here because time is already in years, right? So all you have to do is just do that and you're going to get $3,088.50. So what is my grand total future value going to be after 10 years?
$8,236 even.
Good. Right. All right, last one here. If you have a principal of $684,150 and you got a 3.49 percentage rate and you have 8 months, what is my interest going to be at the end of 8 months?
So converting 8 months to
And it's 8/12.
8 over 12.
And it gives you 15,000 something. I can't get my calculator up.
That's a good guess. $15,000. So, what would my future value be at the end of 8 months?
The principal plus the interest.
Okay, we'll give you $700,067.89. Okay, good. Right, like I mentioned, right? I can't assume everybody can use Excel or have a graphing calculator, so I am only going to be testing you on just simple interest. So that's exactly why we are practicing just simple interest. Okay. All right. Last question of the day is question 16. We are going to complete a bank reconciliation. Now, in this one, this is the formatting that you will see on Orban because unfortunately I can't attach a bank statement, attach a check register, or attach anything more than these simple tables. Again, this is very, very, very simplified because that's exactly what I'm going to be testing you on. It's very simple numbers. So in this case, here's a little table that looks supposedly have all the information you need for your bank statement. Okay. And then I have everything that you need to know for your check register. Okay. So here is, I will also be providing you the actual table to conduct your bank reconciliation. So which side do you want to adjust first? The bank side or the cash side?
Bank.
Bank, okay. So let's go ahead and take a look. What is my ending balance in my bank account?
850.
So in this case, we go take a look at my bank statement. Right here says my ending balance as of May 31st is $850. Right? What do I need to add to my bank account?
Deposits in transit.
Deposits in transit. So let's take a look at my bank or my checking register. Right here, I have checks on the left. On the right side here, I have my deposits. So I have how many deposits?
You got 4 on the check register and 2 in the bank.
Okay, we got good, right? Only deposit number 44 and deposit number 45 has cleared. So, which deposits am I missing?
46 and 47.
Okay, we're missing 46 for $300 and 47 for $450. So again, I'll just type in here 46 and 47 for the $300. Okay, and the 47 for the $450. Okay. What do I need to subtract out from my bank account?
Outstanding checks.
Good, right? My checks that I've written that have not cleared yet. Okay, so in this case, how many checks have I written out?
You got 5.
Right, because that's on my end that I said I wrote 5 checks, but on the bank side, how many of them actually cleared?
3.
Only 3, right? So which ones am I missing?
4 and 104 and 105.
Right, check number 104 and check number 105 here for these amounts here for 50 and 125. So in this case, I got check number 104 and check okay, and check number 104 is going to be $50, and my check number 105 is $25. Okay, so in this case, let's go ahead and calculate my adjusted balance. So in this case, if I started with my bank account at $850, right, that's my ending balance. I'm going to add my deposits in transit. So I have pending $300 plus $450, and I need to subtract out my checks that are pending to be cleared, which I have one for $50 and one for $125. So how much money should I be expecting to have in my bank account?
I believe it's 1475.
14, you're off by $50, 25.
Oh, yeah, there we go.
Okay. All right. You can also find the difference between here and just add it to the ending balance. But in this case, I find it the easiest to just go ahead and just go directly straight through or equal sum it. That's the easiest one, right? So if you could take 850, you can add whatever 750 is, which gives you 1600 minus what is this? 175. You should get that amount. Okay. 1425. Okay. So let's go ahead and do the cash side here, right? What is my ending balance in my cash or check register?
1410.
$1,410. Okay. What do I need to add to my cash side?
ACHs and interest.
Good. Right? Because the bank, right, we can have the bank collect interest from online payments, right? Or ACH is online payments. Interest is what you financially charge them for the convenience of paying via online, right? So in this case, I have interest for $25 and I got an ACH for $175. So let's plug that number in. Okay, so I got interest for, was it for 25? Interest for 25. Okay, and then I got ACH for 175. Okay. And what are some things that I have to subtract from my cash side? What does the bank charge me that I haven't updated in my checking account?
Your banking fees, your NSF fees.
So in this case, let's take a look. What did I get charged? In this case, I got charged a service charge, right? Because again, if I'm using the bank to collect money for me, they're going to charge me money for that too. So I got charged $100. I wrote an NSF fee, or in this case, I got charged because I wrote a check without having enough money in there. And I got a return check fee. That means I deposited money that didn't work and it bounced. So in this case, I got charged $35. So in this case, I have to record all of that. So service charge, NSF, and return check fee. Okay. So service charge, NSF, and return check fee. All right. My service charges was $100. Okay. My NSF was $50. And my return check fee was $35. Okay. So let's go ahead and determine my ending adjusted balance. If I started out in my checking account for $14.10, I'm going to add the interest I've collected, so $25 there, and the auto clearinghouse for $175. And then I also have to take out all of the fees that I was charged for $100, $50, and $35. So what is my grand total adjusted balance here?
1,425.
Right, so I'm going to equal sum this real quick. And that is correct. 1425. Okay, so again, because this number, right, matches my bank, right, there's no difference here. What does that mean? It means I successfully completed my bank reconciliation and everything has accurately been, we made sure all of our transactions have gone through and which ones are still pending. So therefore, we recorded accurate information for between myself and the checking account and the bank statement itself. Okay? So that is the goal. We need to make sure that they do match at the end of the day. And this is exactly what I'm going to be testing you for. So you're going to, it will be looking exactly like this. We're going to get 3 tables, one for the bank, one for the cash or checking, whatever name I call it, right? And then one for you to complete your bank reconciliation, okay? And I'm going to keep it simplified in this, right? Meaning the bank side, I only want you to know your dues, right? Your deposits and transits and your outstanding checks. Where for your cash side, I only want you to know your ifs, which is any interest that you've collected and any fees that you were charged. And that's it, all right? So that is it for the chapter 9 and 10 review.